We just announced today a new lawsuit against the Trump administration. He does not have the right under the International Economic Emergency Power Act to impose these tariffs. We're not going to stand back, and we're not going to continue to get rolled, particularly industries like agriculture, a $48 billion a year industry here in the state of California, largest manufacturing state in America, $412 billion a year in economic output. The impact these tariffs, these taxes are having on industries that are export dependent, particularly industries like the almond industry. Almonds, pistachios, and dairy alone in the state of California represent 43% of our exports to Mexico, Canada, and China. California is going to court to make sure the Trump administration backs down.
The level of tariff increases announced so far is significantly larger than anticipated, and the same is likely to be true of the economic effects, which will include higher inflation and slower growth.
Hey everyone, welcome back to the channel. Today we are diving into a story that is not just about politics, it's about your wallet, your job, your future. The Trump administration tariffs policy have triggered a domino effect that is now shaking the foundations of the global economy, from a new lawsuit filed over the legality of these tariffs to skyrocketing Treasury yields, plugging market confidence, and growing fears of starvation. The signs are pointing toward a dangerous economic storm. We have just got first-hand reactions from policymakers, financial experts, and real-time market data that paints a chilling picture of what is coming if things doesn't change fast. This isn't fear-mongering, it's a reality check. So buckle up. In this video, we are breaking it all down. Why California is taking the Trump administration to court, what rising bond yields are telling us about American economic credibility, why the Fed is staying on the sidelines while investors are begging for help, and how this all ties into a potential repeat of the economic crisis of the 1970s. This is one you won't want to miss. Let's get into it.
Trump is losing this trade war, and it's pretty evident if you pay attention to the bond market. A bond is basically a share of U.S. debt. So you as a citizen can go on the Treasury website and buy a bond from the U.S. government. And what you're doing is you're lending money to the government. And in return, they pay you interest on that bond. And you can cash it out in, 10, 20, 30 years. They're usually long-term bonds. These rates are important because they typically determine other long-term interest rates like mortgage rates. But Trump has been trying to force the Federal Reserve to lower short-term interest rates in the hopes of eventually lowering long-term interest rates like mortgage rates. But the Federal Reserve is supposed to be a separate entity from the federal government, and they are supposed to operate with the best interest of U.S. citizens in mind, and they basically just monitor inflation and unemployment rates. And if they're not lowering interest rates, it's because they don't think it's a good idea. So when Trump didn't get his way, he put tariffs on a bunch of countries, tried to crash the stock market, and force people out of the stock market into the bond market because they're typically a more secure investment. And when you have higher demand for bonds, the interest rate goes down. So I think this was just a workaround for him to try to lower interest rates another way. But the opposite actually happened because a bunch of other countries like China and Japan buy US debt through the bond market, and they started selling their bonds when you would not expect people to sell their bonds. And other people saw them doing this, so they also started selling their bonds because they expect interest rates to go up. And when you have a higher interest rate, it's a better investment for somebody who's buying bonds. So you sell off your lower interest rate bond and buy a higher interest rate bond. And you can see right here in this 10-year rate, it increased significantly after Trump's tariffs, which is exactly the opposite of what he wanted to happen. His tariffs directly impacted the value of the US dollar and made it more difficult for the US to borrow money. And I think that's why he took them off so suddenly.
Look at this. I took this picture about 10 minutes ago. The 10-year Treasury note is at 4.5%, and it's climbing. Yeah, as you can see here, it's going up. And that is really, really bad news, because as this heads towards 5%, 5% would be complete disaster. Yeah, and that's only happening for one reason. It's happening because people are losing faith in the United States. They're losing faith in us. So that's why Treasury yields are going up. They're going up because countries are going, I don't think I'm going to keep loaning money to America. I think I'm going to pass. And if that keeps happening, within a month or two, the United States is bankrupt. I want you to understand right now, right here, just how dire it really is. Because around the world, they do not believe in this administration. They don't believe anything this administration has to say. And now the full faith and credit of the United States is under suspicion. And that is a massive problem that I can't even begin to tell you how dangerous that is. And now the Republicans are pushing a budget bill that throws $5 trillion on top of what we owe already. It is a recipe for complete and total disaster. And no one is saying, wait a minute, you are literally leading us into a disaster. Yeah, but I'm here to tell you, this is a nightmare and it's all coming true right in front of our face. Like and follow for more. The next 2 months are going to be possibly catastrophic.
Let's talk about the so-called Fed put, because Fed Chair Jerome Powell just told investors that that's not happening.
Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no.
The Fed put is a term used in financial markets, which basically suggests the Fed will come in and will save markets, especially during economic downturns. This most often comes in the form of rate cuts, but they also have other tools that they can use to try and prevent some of these financial meltdowns. It's essentially the idea that the Fed can be the safety net for financial markets, especially during periods of very, very severe volatility, which we've pretty much seen throughout the past several weeks. Some recent examples of the Fed put in action include the 2008 financial crisis. That's when the Fed aggressively cut interest rates. They also launched something called quantitative easing, which was another way to help stabilize markets. And then you have the March 2020 COVID-19 pandemic crash. Again, we saw interest rate cuts, we saw QE, we saw emergency lending programs, and all of that really helped calm a lot of the market jitters. So flash forward to today, with all the craziness going on in markets right now with Trump's tariff policies, a lot of investors thought maybe the Fed would come in and help us out, do us a solid, calm our nerves during these uncertain times. But Powell said markets are currently doing what they're supposed to do. They're reacting to this volatility and they're functioning as normal. It's clear Powell prefers to wait on the sidelines right now. He's consistently talked about he's just not sure how Trump's policies, whether it be tariffs, whether it be immigration, how that's actually going to show up in the data. And as a reminder, the Fed has two dual mandates. One is maintaining price stability, i.e. keeping inflation in check, and the other is achieving maximum sustained employment. And the Fed is data dependent. They are mostly reactionary. And that's where a lot of investors take issue. Because what if they're too late and they don't cut interest rates in time and then the economy falls apart? Obviously, that is the biggest risk. But from the Fed's perspective, they don't want to rush and cut interest rates if they don't have inflation in check yet. Right now, inflation is significantly above their 2% target. If they cut rates too soon, that's a risk that inflation could move to the upside. And if they don't have control of inflation, that's going to hurt the first part of their dual mandate, maintaining that price stability. So essentially, the Fed is operating under an abundance of caution, but at the same time, they're acknowledging that these risks from the Trump administration, they're very real when it comes to the impact that they could have on the economy. But that doesn't mean they're going to come in and save your stock market portfolio. They don't really care about that. Much to the disappointment of all of us investors. Sorry.
So head of the U.S. Federal Reserve, Jerome Powell, basically without saying it, said we are on our way to stagflation. He was quoted to say the level of tariff increases is just far beyond anything we were expecting at the Federal Reserve, and that the situation we currently have is unprecedented, and really we don't have anything to compare it to know how to run the playbook of the Federal Reserve. What is stagflation? Stagflation is basically a period of economic decline, but still having high inflation, where normally inflation is tied to economic growth. Inflation causes all the things you don't want to see. It causes unemployment to skyrocket, it causes goods to skyrocket in price, it causes consumer confidence to plummet, and the cycle just continues because there is no real playbook on how to get out of the stagflation cycle. The last time we had stagflation was in the 1970s, and it was due to the oil crisis and basically led to the modern invention of supply-side economics in order to attempt to circumvent stagflation in the US. Now, what are we going to do to get out of stagflation this time? I don't know, maybe turn the tariffs off that are 245% in China? That's just a thought, maybe a quick one.
Let's be clear about what is happening right now. The United States is in the middle of an economic and political crisis that is unfolding in real time, and the consequences are stacking up fast. California just announced a new lawsuit against the Trump administration, arguing that the tariffs being imposed under the International Economic Emergency Power Act are illegal. That law was never meant to be used as a weapon in trade policy. It's meant for genuine national security emergencies, not as a tool to strong-arm economic partners or attempt to manipulate inflation and trade balances. What's at stake here isn't just legal precedent, it's the real-world fallout hitting industries that depend on a global trade to survive. California agricultural sector, which produces $48 billion annually, is reeling. This isn't small potatoes. We are talking about almonds, pistachios, dinarates, commodities that make up to 43% of California's export to Canada, Mexico, and China. And these markets are now retaliating with tariffs of their own, pricing out American producers. Entire communities that rely on this export are feeling the pinch. But it doesn't stop at agriculture. California, the largest manufacturing state in the US, is responsible for $412 billion in economic output. These tariffs are functioning like a slow poison. They are acting like taxes on American companies that depend on raw materials, parts, and open markets. It's not just about economic theory. These are jobs, livelihoods, and tax bases that fund schools, healthcare, and infrastructure. Now, if you want to know how bad things are getting, look at the bond market. Treasury yields, particularly the 10-year notes, have surged to 4.5% and they are still climbing. For context, this is the market way of signaling that investors are losing faith in the US government's ability to manage its finances. Yields rise when bonds prices fall, and bond prices fall when investors sell off because they are spooked. And when investors start exiting US debt, it's not just a red flag, it's a fire alarm fire. If this hits 5%, we are not talking about a soft landing, we are talking about a complete financial discolation. And the reason it's happening is simple. Foreign governments and major investors are starting to say, I don't trust you anymore. They are opting out, and when confidence is the full faith and credit of the US erodes, we are in the uncharted territory. Now, combine that with a Congress that is trying to push through a budget that adds another $5 trillion to the national debt. That is a recipe for fiscal collapse. Not in 5 years, not in 10 years, possibly in the next few months if confidence continues to spiral. And where is the Federal Reserve in all of this watching? Jerome Powell made it crystal clear there is no Fed put coming. That is, the Fed is not going to intervene to rescue markets like it did in 2008 or 2020. Investors are on their own. Powell said markets are functioning as expected, reacting to volatility, prices, risks, and adjusting accordingly. And he's right, but that doesn't mean it's not painful. Many were expecting some kind of intervention, rate cuts, illiquidity injections, emergency facilities, but Powell is being cautious. Why? Because inflation is still well above the Fed's 2% target. If the Fed moves too early, cuts rates before inflation is stemmed, we risk a return to runaway price increases. And that leads us directly to the real nightmare scenario, stagflation. We are inching closer to it every day. Powell himself said this wave of tariffs is unlike anything the Fed have ever seen. It's unpredictable and historically unprecedented. That should send a chill down your spine. Stagflation is when you get the worst of both worlds: stagnant growth and rising prices, employment spikes, consumer confidence plummets, and no one has any idea how to fix it. The last time we saw this was in the 1970s during the oil crisis. The results: massive disruption, a generation of lost economic potential, and an economy that lived through a decade of instability. Now we are staring down something very similar, but this time is self-inflated. Tariffs over 245% on Chinese goods, retaliatory measures from other major economies, collapsing confidence in US debt, and Federal Reserve that stuck between a rock and a hard place. Let's also be honest about the strategy behind these tariffs. The Trump administration is trying to manipulate economic level to force the Fed's hand. Tariffs disrupt markets, crash stock prices, push money into the safety bonds, at least in theory. That should lower bond yields, and here is the kicker: it backfired. Foreign countries, especially China and Japan, started selling US bonds instead of buying more. Why? Because they don't want their finance a chaotic, unpredictable economic regime. So instead of bond yields going down, they are going up. And when yields go up, borrowing becomes more expensive for home buyers, for businesses, and for the government. That weakens the US dollar, further inflation influence, and tighten the economic vice we are already stuck in. This is the exact opposite of what was intended. It's economic malpractice, plain and simple. Now here's the brutal truth. There is no quick fix. You don't just flip a switch and undo these consequences. Markets take time to stabilize. Trust takes even longer to rebuild. The lawsuit from California may slow things down or stop the new tariffs from being implemented, but the damage is already done in many sectors. We need leadership that understands how global markets work, how monetary policy interacts with trade, and how fragile investors' confidence really is. This is not about ideology, it's about competence, and right now we are lacking it at the highest levels. So what comes next? Expect volatilities, expect more layoffs, expect your groceries, your rent, your credit card interest, all of it to keep going up, and unless we see a major policy shift or intervention soon, the next few months could define the next few years of the US economy. We are on the edge, and whether we fall off depends on whether our leaders stop playing political games and start making real informed decisions. If you find this breakdown helpful, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss our next deep dives. Got thoughts or questions? Drop them in the comments. I read every single one. Thanks for watching, and I will see you in the next video.